Are you looking to step up your option trading strategy?
All right, testing, 1, 2, 3, testing, 1, 2, 3. You said there's an issue with the mic. Is it clear now? Well, I had the mic on apparently, so the mic would have been picking up the music that I was playing. So, but if it's still there, I'll unplug it. All right, but it's still there. All right, there's still something going on. All right, I'll unplug it and replug it. All right, how are we doing now? All right, let me grab my coffee and we'll begin. All righty, the rain in Spain falls mainly on the plains. The ants in France stay mainly in your pots. Good morning, everybody. It is a Monday. Today's the day we're going to go through the calendar looking at event risk. We're also going to look at the Commitment of Traders report today. We'll try to squeeze in some technical analysis. It's the first day of a month, so you should be well into your monthly position trades. Maybe you should be in your weekly swing trades. You should be in your day trades. So without further ado, let's get on with it. 3, 2, 1, hit it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Mohammed Yosef says, hey, do you guys use a scorecard to analyze fundamental indicators? Look, fundamental indicators are used by central banks to set their policy. So every, 2, 3, 4 years they change their policy. That's all you need. Okay, there's a big difference between news and fundamental analysis. So the news is relevant only to the point where it will change the central bank's policy. Right now, the Fed's policy is not likely to change for years because they told us that. Now, maybe things will change. Like maybe inflation does go crazy and will force the Fed to change their policy. But it wouldn't be until they started hinting that they would do that. So ultimately, that's the fundamental part of your analysis. So there is a big difference between just news and fundamental analysis. Okay? So you shouldn't need a scorecard. So there was 1 minute on one day, I think it was April 9th of last year, the Fed changed their policy, and I was done. I don't need another scorecard. And since then, they've told us that policy is likely to stay the same for at least 3 years. So that sets my policy for 1,000 days. I probably don't need a scorecard anymore. I need to build portfolios, okay? So a scorecard would be if you're a pretty short-term trader. Got nothing wrong with it, but honestly, fundamental global macroeconomics, those trends last for years. Okay? But, yeah, keep a scorecard, sure. Anyways, good to have you guys here. First day of the month, right? First day of the week, lots of things going on. Looking forward to it. I hope you were trading yesterday when the market opened. I was. We had a pretty nice open. And then like you'd expect at the beginning of the month, a big flippy flop on a lot of things at the London Open. So where everyone's jostling for position. Okay. Stevie says, hey, in the London session, would traders concentrate on buying and selling pound, or would they sell all currencies? Well, it's like if there's, I think of it this way. In the Asian session, Asian currencies tend to trade more because it affects those economies more. And then European currencies tend to move in the European session because they're affected by these transactions. And remember, not all participants, in fact, most participants in our market are not actually traders. They're just doing business. So when the London banks open, guess what? They're going to transact a lot of transactions in pound. They're going to do that a lot in pound because, well, they're British banks. So don't think of them as traders. Think of it as economic activity. Okay? All right, Stevie? Steve Move? All right, so again, today I think I'll cover the calendar. I think we should go through COT just for fun and all that kind of stuff. So ask questions, get involved. Please leave comments on the recordings. And also, I'd like to thank our execution partner, I guess you would say, tradersway.com. You're a trader, you're going to need a broker. Why not try Traders Way? Tradersway.com. Open up a demo, play some trades. What are the things that a foreign exchange trader would want from their broker? One, they want to appreciate their business model, appreciate who they are as a culture, let's say. The second thing is you're going to need execution speed. You want fast trades. You don't want slippage. You're going to want competitive spreads. You don't want to overpay. But again, if you go with the broker just because they're cheap, then the first issue, the slippage, is going to be a problem. So they might promise you a half a pip on the euro dollar, but they'll slip you a pip in, slip you a pip out, and you end up paying too much because you got suckered into a sucker's bet. So, and then what? You want high yield, right? High yield, you want to collect your swap. Many brokers won't even pay you the swap. They'll charge you swap instead of, right? So you pay negative swap irregardless of whether you're long or short. That's another sort of process for many brokers. So anyways, you'll find execution speed at Traders Way is fast. Swaps are big. Spreads are narrow. If you want ECN, you can have an ECN account. So tradersway.com. All right, here we go. Oh, that is terrible coffee. What happened today? Oh, that's interesting. So Mohammed says, so, hey, Daniel. So Daniel's responding to his question too. So you only focus on central banks. Well, that's the only thing you should. So going back to news. Okay, so here's a calendar. Let's pull up the calendar because we need to go. So great transition. Thank you. All right, so all of this is news. Okay, these are events on the calendar. And they're economic reports. They're news releases. And so there are different organizations. Many of them are government, some are non-government, but many of them are government, and they're analyzing economic conditions. Yeah, I don't know anything about that, actually. Meta, the Fed canceling, so I don't know. I don't know anything about that. I don't think I don't remember a Fed meeting ever being canceled. So I would have to look into that. Okay? Honestly, I don't remember that. I've had surprise Fed meetings that have happened, non-scheduled meetings, but a cancellation, I don't, right? No. So, anyways, going back to this. These are news releases gathered by different departments of the government. For what purpose? Okay? I want you to think about that. Okay, Mohammed? What purpose? What is the purpose of gathering this information? Okay? Ultimately, the government has goals for itself, for its economy. Things like reasonably decent employment, reasonable inflation, reasonable economic activity, all this kind of stuff, right? And so why would they, if you have these goals, then you want to somehow influence the outcome, okay? So therefore, you have to create agencies that might be able to do something to influence the economic activity that you're trying to achieve. Sometimes there's not enough economic activity, which leads to high unemployment. There are other situations where inflation is much too high and it has become hurtful. Okay? So, those two situations need to be addressed, and the government has created two ways to address these concerns. One, they have a central bank that can change monetary supply, right? Money supply, the supply of money, the amount of money in the economy, or interest rates, which is sort of one and the same. And then the second thing the government can do is have the Treasury do things like print money and give it to people. Okay? And there are strengths and weaknesses to each of these policies, and ideally they should work in conjunction with each other, not against each other. So all of this information, Mohammed, gets boiled down to what is the fiscal and monetary policy of the country, and that is what influences the value of the dollar. Okay? So when you're like, hey, so do you use a scorecard? Well, you could use a scorecard here. You could gather employment data, inflation data, productivity, the factory capacity, utilization numbers, but it all boils down to the same thing. Is a change required in these policies, the government policies, in particular the central bank? Okay? And that's it. So if a policy is enacted, then you're going to use this information to say, is there a reason to change the policy? Because you're already trading. You're already trading the current policy. Okay? So now you're keeping this scorecard, and let's say you track all this information. In particular, like for the Fed, you're going to do like non-farm payrolls and all that kind of stuff. You maybe have an ADP in there. You're going to do PMI, and you're going to put all in this. And is there inflation? Is there an increase? What is the rate of change in inflation? How's employment? Is employment improving? What's the rate of change in the improvement? This kind of stuff. But let's say for the next 2 months, there's an improvement there, right, in inflation, an improvement in employment, and all that, but not to the degree in which the Fed will change its policy. Okay? You're using a descriptive statistics, right, in order to define upper and lower limits. You're on the wrong path. Go ahead and do it. It's a great great academic project, but it's overly complicated. It's too late, and you're on the wrong. You're hunting down the wrong path. Okay. So right now, I want you to answer this question for yourself, Mohammed. What would make Jay Powell stop buying bonds? Okay? That would be a change in the policy. He said he's not going to do it. The last policy was, when are they going to go to negative interest rates? And on April 9th, they said they're not even thinking about it. They ain't going to do it. They're not going to go negative. So that means they got to the point where they were at zero. They had to go, if they were going to expand what they were doing, they would have to go negative. And they said they're not going to go negative. So that's the end of that. Okay, that's why I said that was a change. They cannot do more than that. So that is a floor or a ceiling, depending on how you look at it. Okay, so now they're going to keep doing what they're doing now. They're not going to do more. They're only going to have to do less, but they're not even thinking about doing less. So you have to now, in my opinion, Mohammed, follow the Central Bank of the United States if you're thinking about the US dollar, and engage with the information they offer us, and they're very transparent. And at some point, they're going to hint that the policy they're doing now is unneeded. And that would be a change. So, Mohammed, you can keep your scorecard, but it won't matter until they hint. And they've already told us it'd probably be years. So your scorecard would be a great academic exercise. But as far as setting up trades, it wouldn't matter. Okay? It wouldn't matter fundamentally, because the fundamentals are based on global macro, and global macro is impacting the U.S. economy. Okay? So I don't say don't do it, but the way you're putting it together, it's just, it's overly complicated, and it's not quite the right thing. It's helpful information. And if you know the decision, like for example, last year I said GDP is going to be close to 6% in the United States. So we already knew that a year ago. So now if we have a really big GDP come out for the United States and it's 4 or 5 or 6%, typically we only get 2, it's not because something has fundamentally changed now. That was 8 months ago. So we've already made that trade. Okay. So anyways, great academic exercise, but too slow. Okay, cool. So let's go through the calendar. Oh, Mohammed Yusuf says, I'm trying to get how you can define the USD weakness. Because they tell you. I'm telling you, Mohammed, they tell you. They are going to continue weakening the dollar for at least 3 years. They've told us straight up, at least 3 years. Okay? And what was the language they used? Jay Powell said, what was the language? You guys remember? I did a big speech on the productivity gap. The difference between potential and actual GDP and closing it. And then he used some language to say once we get actual GDP above potential GDP. Do you guys remember the language? I honestly don't remember. It was overshoot, wasn't it? I think you said overshoot. All right, so let me just quickly answer this for Mohammed, because it's sort of a good review. So Mohammed, this is something we talked about, I don't know, 4 months ago, 5 months ago. So let's do it this way. Let me clear this up. Template blank. Okay. So you have potential GDP. Okay. When you look at the factors of production, you could say that this is so you could call it GDP, but economists would call it Y, output, right? This is the potential GDP for the economy. And if you were going to use a production function, you might say, Y is equal to, I don't know, square root of 5 or something, right? But anyways, we'll just call this, but I'm trying to erase. Come on, eraser. There we go. All right, so this is GDP. So actually, let me erase this. Keep it simple. Keep it simple. Okay. All right. So GDP star. I'll make GDP star potential. So if you use all the factors of our production in our economy, okay, you're going to get this kind of output, which means the economy is slowly going to grow at 2% a year, let's say, on average. Therefore, 2% a year would look like this. So you have this over this. So this is time, and this is productivity. Okay. So over time, the economy will grow. But we also have business cycles. Okay. Unemployment, high inflation. Unemployment, high inflation. Okay. So let me actually redraw that because I need to zoom in. And so we'll zoom in. Okay. Okay, Mohammed. And so this is what we're talking about now, where on April 9th, the Fed said that, we were at the bottom and things are going to improve. There's no need to go to negative interest rates ever. Okay. Okay. And then he said he will allow inflation to overshoot. So what I discussed, I don't know, was it 4 months ago, 6 months ago? I don't remember, but I discussed the distance between here and here being a productivity gap, where actual GDP is quite low, but heading back up because of less COVID restrictions at that time and expected in the near future, not just in the United States, but globally, so we can trade more with our trading partners. I hope you're following me, Mohammed. Okay, so we call this the productivity gap. So we need to get back to actual GDP. So let me label that properly. So this is GDP, and this is potential GDP. So in the near future, we need to be moving up to a normal level of productivity for our economy. So that means unemployment has to fall, right? People need to get their jobs back, and so on and so forth. Okay, and we start producing and consuming and saving and investing at normal levels. And what Jay Powell said, and I think it was around April 9th, that he was going to allow inflation. So let's just call inflation higher levels of productivity. It's not a great way of doing it, but it's a reasonable way of doing it. To say when we're overproducing beyond potential GDP, which means GDP at, let's say, 2%. So if we have GDP at 3% on an ongoing basis, then the Fed will allow that to happen before they need to remove accommodative policy. So right now, at this point, they're accommodative. They're increasing money supply. They're buying bonds. They're buying long-dated maturities as well as short-dated. They're doing a lot of things to stimulate the economy, to improve productivity through employment and such. Okay? And then even the fiscal government is coming in and giving people with no money so that they can push up consumption, which then would lead to future economic activity and back to potential GDP. Now, the Fed said they will allow it to overshoot, which means beyond the productivity gap, we get back to potential GDP and higher. At that point, the Fed won't need to be so accommodative, and he'll have to change the policy, and he expects that to be 3 years. So Mohammed, if you keep a scorecard, it'll tell you whether you're here or 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 here. But meanwhile, what he said here is all that mattered. The dollar's going to weaken. So if you're here, the dollar's still going to weaken. If you're here, dollar's still going to weaken. If you're here, dollar's still going to weaken. Dollar's here. So now you're tracking PMI in your scorecard, and ADP in your scorecard, and GDP in your scorecard, and weekly jobless claims, right, in your scorecard, CPI in your scorecard. And you're tracking all this stuff, and it's all good, but I'm just shorting the dollar. I already know all this stuff. And you don't have to keep massive details on this because you'll know it, and they'll come out, and when you have Fed meetings and Fed testimony, they'll tell you, yeah, well, we feel like we're beyond, potential GDP, and we are concerned about whatever, or we're closer to full employment, right? Or inflation is a little bit of a concern, and we have the tools to deal with it, which would be hint, 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 wink, wink, wink. Change in policy is coming in the next 3 to 6 months. So now you can start thinking about should that lead to dollar weakness or dollar strength. Okay? But we have all of this to go through. Okay? And your scorecard would just keep score, but you already know the strategy of the game. Okay? So I was literally done. As soon as he's told us this, I drew it all out for everybody about the productivity gap and having actual GDP overshoot potential GDP. Okay? So it's better to keep it simple. Yeah, understand. Think of it this way, Mohammed. This is how I recommend it. Like, if you're interested, you should probably go through my fundamentals course, which I'm going to rename monetary policy course, right? Or central banking course, because what I want you to do is keeping a scorecard it's an academic research process, which is fine, right? But I want you to think like the central banker, not like the research analyst. What would the central banker do in a situation where, yes, we do have a pickup in inflation, we do have a pickup in employment, but we're still below potential GDP? And by the way, 5% GDP is expected, so it's not worrisome. The news is going to freak out, and everyone's going to freak out. But I talked about it 6 or 8 months ago. I mean, it was summer when I talked about it. So I think it was July. During Off the Charts with Wayne McDonald, I predicted that we'd have like a 5 to 6% GDP in 2021. Okay? And so when we get this information in a couple of months, people might freak out and say, that's why the Fed has to raise interest rates. But it's funny because the Fed would have known that when I knew it, because I'm not that smart. So the Fed already knew that there was going to be a high GDP, and they're kind of maybe warming us up to that, but it's not a game changer because in 2022, we're going to have 1.8% GDP. Oh, you did that one. Okay. All right, so you see what I mean? So think like the central banker. Okay, don't think like the analyst. Don't think like the quant working at the central bank, crunching out numbers. All you care about is what does it mean and when is it going to change? And it shouldn't change anytime soon. Okay? Okay. Someone might use your scorecard to try to get a scalp on and make, 50 pips or something like that. But that's not fundamental analysis. Okay? That's trading things like a surprise, right? A glitch in the matrix. There's always an outlier that can lead to very, very short-term volatility. right? Or a change in the rate of change kind of data where retail sales has been slowly improving, but all of a sudden there might be a big improvement. So maybe that leads to a move today, but a move today is not fundamental. Okay, that's relative strength. And so you get a slight, right? So like think about like retail sales. Think about it this way. Okay. When you look at retail sales, let's say things were bad, retail sales numbers were down here, and then things were improving, okay? And things are improving and things are improving or whatnot over time, okay? These are all data releases. And every so often you get a really big number and that's really good, or you get a really bad number and that's really bad, okay? That would be where your scorecard comes in to say, wow, because a lot of these releases, they come out and they're like, did you see the number? It came out at 22. And you're like, 22 what? I don't know. The number is 22. And you're like, well, is 22 good? Is it bad? What's normal, right? So what we care about as fundamental macroeconomic trend traders, we care about this. That's what we care about. Not the individual data points, because that could be short-term weakness or short-term strength, but we're not interested in short-term. As a macro trend trader, we want the long run. We want to go, right? So I'll look at this and say, well, short the dollar in all cases. And if there's a low outlier, right, within 2 standard deviations of this mean, well, then I probably let the dollar strengthen for a day or two, and then I sell it because I know the long run trend will prevail, right? So y equals mx plus b, okay, is the formula to create this, right? And then from that you can create 2 standard deviations and find your outliers, right? So you just ignore your outliers because all these economic releases, by the way, on the calendar, they get revised. So this outlier is going to get revised and all that kind of stuff. So we don't really even care about the outliers. And then now you get this trend, and you get above trend or below trend. And what you care, Mohammed, is what if one day the data starts looking like this? It's all down here. And then you start getting more low outliers. Well, then what'll happen is M, which is your slope, your rise over run, will start turning more negative. Okay? Every day becomes less good. And then one day you might get a new slope. And that, right, this change might lead to a change in policy by the government, but we won't know that. I mean, we will be told by the government well before any change is made. So your scorecard would be interesting if you start to get a change in slope and all the retail sales data, for example, is just bad, right? Lower than expected, month over month over month. But then we would be well in tune to that anyway. So do you need to have the scorecard? And then, of course, your scorecard, I don't know. Again, it might lead to some trades, but I mean, I guess I go back to saying what I was saying. It's not that you shouldn't do it. Go ahead and do it. It will certainly not hurt. It'll keep you focused on gathering intelligence and formulating a strategy. But ultimately, your overall strategy is going to be more influenced by the business cycle and by seasonality than by any dramatic change in your scorecard, because those other things would have explained it before you even saw it. Does that make sense? Okay. So every once in a while you have to say, okay, there's big ears, there's big toenails, there's a trunk, there's a tail, it's gray, it's got rough skin. Every once in a while you should just step back and say, oh, it's an elephant. Okay? I'm like, dude, we're selling the dollar. Right? For the last 8 months, I've been selling the dollar. I'm most likely going to be selling the dollar 8 months from now. So in that case, do a scorecard, sure. But it's not likely to change your fundamental, okay, fundamental analysis. But it would be very helpful. I suppose if you didn't understand monetary policy, it would be helpful. It'd be helpful if you wanted to make a short-term trade, like if you're trying to make 200 pips a month, okay, maybe it's helpful because you're spending your whole day picking up pennies, right? But if you're truly a trend trader, then these data points are just data points in your data set, but your data set has already told you within 2 standard deviations what the slope of the mean is, and you're trading that. Okay? So again, I don't know if it's gone. Okay. So if you have a trend like this, it's extremely unlikely you're going to get a data point way down here. Okay? Let me clean this up. Okay? And if you did, it wouldn't say the Fed's going to change its policy. You'd have to have multiple versions of that. But more likely than not, there was a data gathering error or something, and it would be adjusted back in. So I look at this, I'm trading the last 200 data points, or the last 24 data points in, let's say, employment or inflation or GDP or factory capacity and utilization statistics. They all add up to, I have this data set and it's going to look like this. And because there's a reasonable size to the data set, it would take a lot of data to change that. So a scorecard, it'd just be sort of like obvious, I suppose. Okay? And you'd be well in tuned to it. The downside is you might get thrown off by seasonality or by a business cycle change, and you say, that means you should be buying the dollar, and so you end up buying the dollar for 1 or 2 months, or let's say a month, and you're doing well, and then you give it back the month after because the trend takes over, but you're still trading your scorecard, which more than likely is a bit behind. Okay? Because you'll say, well, it worked last month, and then you give it back. So, the worst thing would be your scorecard takes you off trend because of seasonality. Sorry for the long answer, but it's a pretty interesting question. Okay? Because again, I can't imagine it hurts, but in that situation, if you're trading, you could misdo it. You could misdo it. You could forget you're staring at an elephant, and so now you're debating whether it's an ostrich because of its feet or something. Okay. Right. So Mohammed says, yes, it's true. I can see USD strength right now, which is I predicted months and months and months and months ago because it's seasonality. This is not because of a change in policy at the Fed. It's not because of some data points coming out. Right? So in this case, it's actually a difficult month for many traders. So I've explained, like, we'll just take this trade that here that's staring at us in the face here. I'm actually selling US dollar right now. And I agree with you, USD actually could be strong. And I know that in this month, because of seasonality, I could totally see dollar getting strong. But on the long run, I am bearish. So what's happened here is I let the dollar get strong for 2 days, have it rally up from 24.5 to 27.5. So I let it go up like 300 pips. And now I'm selling it knowing I probably won't make money. Peter, business cycles are typically 8 to 10 years. Okay? And that's where you need to study like yield curve. Okay? But I am creating a macroeconomics course, so I'm working on 2 different lectures right now, and it feels good. Like it feels good. It feels like a good course. But it'll deal with that. What a business cycle is and why it's created, to probably a degree which is surprising, actually. There are simple answers, and I'm not giving the simple answer, so, but that should be straightforward. Think about it this way. That's what an analyst does for a living. People have that job. Where are we in the business cycle? Okay? There's a business cycle and there's a real estate cycle, which I think is really interesting. There's a political cycle. And then there's a cycle to the cycles, which are super cycles. So like you could even say how many times in the last 1,000 years has a superpower been challenged by an upcoming power? And what does that do to the upcoming power? What does it do to the established power? And you can study all these things, right? So you can have 100-year cycles. Okay? Anyways, so let's go back to this. Yes, USD has a very strong likelihood of rising in March. However, okay, we'll put that in a box. So that's March. So I have to choose. Do I want to make money doing that in March? I can if I want to. I can develop a strategy to do that. Okay? The second thing is I can say, well, what about 2021? Well, I think US dollar will be down in 2021. So how do I play this? And there's multiple ways of playing this. I can bet that I'm right in March, but that's only March. That's only like 3-4 weeks, right? Depending on when you start, when you stop, and all that kind of stuff. But it's 4 weeks, let's say, out of 52. And what if I'm wrong on the short run? What if I'm just more right on the long run? Do I really want to lose money betting against my own analysis? Well, I've done that before, by the way, trying to be sort of overly smart, where I'm like, oh, well, January's going to be down, February's going to be up, March is going to be down, but April's going to be up, and May is going to be up, and then the first 2 weeks of June will be up, but then the last 2 weeks of June will be down. Like, I actually think this way, but I don't trade that way. So now I have to think about, how do I want to handle this? Because the worst case scenario is I'm right on my long run, and instead of making money, I throw it away trading against my better self, trading against my better judgment. So then instead of making money, which was obvious, I ended up losing money, and now I'm not so sure I have the skills required to even do my own damn job. So one way of doing this is to say, I understand in March the dollar's going to go up, but maybe I look for opportunities to sell dollar as best I can, manage the risk as best I can, and try to keep downside risk, aka loss, try to keep my loss to a minimum. Okay? And maybe, just maybe it all works out okay. Okay? So I get myself in a situation like this, where, yes, the US dollar can be strong in March. Okay? I understand that. But, for example, how do I sell, right? And that's a bearish move, by the way. Let it go up 300 pips and sell it off the top. Okay? See? There's my stop. I can move it in, and I can keep trying. I can keep trying. So that's me saying, I let the dollar be strong, and now I'm going to try to weaken it again, and then understand it. I'm probably not going to make money on this. I'm probably not. It's probably going to do one of these things. Okay, well, in that move, hopefully by then I can break even or have a small loss. Okay, so like, for example, now I move my stop here. Now I'm risking 31.5 pips. Can I survive a 31.5 pip loss? So Peter says, so that's a counter trend trading, right? No, because the trend is down. I just said dollar weakness, US dollar weakness. That's the long-term trend. So is this counter trend selling this, Peter? No. Yeah, you probably thought it was euro dollar or something, right? You have to inverse it, right? So I am trading the macro trend. I understand, however, and this is important, by the way. I understand that there's a minefield in front of me. Some people are just walking, la da 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 da, and they get caught by the dollar strength. Okay? I mean, think about this. We got dollar strength on the second last day of February, and yet, let's say 6 months ago, 8 months ago, we talked about March being dollar strong. In particular, yen strong too. So it's just amazing it happens on the second last day of the month. You know, it's like people saw it coming too, and they got in early. All this kind of stuff. Whatever. So I feel like I'm in a minefield, and every trade is dangerous. Okay, every step is dangerous, and I'm doing my utmost best to make sure there isn't a landmine beneath me. But I need to go on that trade south. I'm trying to get home. I got to get home to my family, and I have to go straight south. Right in this case. I am trading south. I got to get home. I am heading south. But I'm in this particular time of the year, I am every step, I'm double and triple checking that I don't blow myself up. And I think the attitude is, I don't know, what sort of saves you. Okay? What sort of, right? So we'll see. What I'm hoping for, remember the market doesn't care what I hope for, but I'm still doing it. I'd like to see a move like this, okay? And that where we are now holds. So like this to this to this, okay? And where do I get this kind of confidence? Well, based on the rules of engagement that I teach you guys every single day and in the training course and in my books, right? You sell here, and this is the most aggressive target you could have. This is a confluence, and this is the conservative target, in which all bears will get out. Oh, look, it happened. So I know it works, and I say, I understand what's going on. I understand what other people are doing. Now, the next step is, will the bears return? And I have two areas on a monthly basis, here and here. These are two prices I'm interested in. And then on a weekly basis, I want to be short somewhere in here. Oh, look, I am. You see it? Like, well, that's exactly where I shorted. On the first day of the month. In the first hour of the first day of the new month. I was short in a zone which it was quantified ahead of time. And I understand that there still might be, I'm not through the minefield by any means, but I got one or two steps in, and I'm making my way south. Okay? Alejandro says maybe around new stimulus. Well, does it, right? We actually had a very specific day in the swing trading group. We identified one specific day, but if the Fed meeting has been canceled, which I don't know anything about yet, well, that brings up a lot of questions. So I don't really know how to handle that. Like, I'm thinking about it. In 20 years, I don't think a Fed meeting has ever been canceled. So I'd find that quite shocking. I'd have to say, well, maybe Jay Powell is sick in the hospital with COVID or something. But you'd think you'd be able to do that with... Oh, it's not. Okay. Thank you, Maida. March 2020 was, because of the COVID thing. And okay. It's funny, I don't remember it being canceled. Okay. Richard, no broker in the world would be good for you with high leverage. Just the way you asked the question, Richard, don't do it. Right. But Richard, do not use high leverage. Okay? Save yourself the effort. Instead of just throwing your money at the market and losing it, just stop. Shoot, if you're going to throw it away, give me the money. Like, dude, like, what do you mean high leverage? Yeah. Well, first of all, the maximum leverage in the United States is 50 to 1. So like, whoa. Richard, you need to slow down. Trust me, please. Just slow down. Right? Hang on. You need to find a broker that will offer you a demo account, which means any of them. Okay? Okay? And spend 1 year trading a demo account. And I'm telling you, if you can't, you're like, Wayne, I'm not willing to put in a year on a demo account, then just don't even open an account with anybody. Okay? I mean, you're just going to lose your money. Who cares? Right? There's no quick and easy, my friend. And you're like, 100 to 1 is not good. What you're telling me is you don't have any money, Richard. So why don't you get some money? Get some money. Work 3 jobs. Work 5 jobs. Sell everything you own. Get some money. Yeah. 50 to 1 is more than enough. More than enough. Well, your trading sucks, Richard. Right? Like, think about it. More leverage is not going to make you a better trader. It's not going to make you more money. You're going to blow up your trading account. So your issue is you're not making any money. That's the issue, Richard. So I go right back, start trading a demo account, come to my webinar every day, and I'll fix you. I'll fix you. Because you don't have any money, so you can't afford my courses. You can't afford my live group. Maybe you can buy my book. I don't know if that'll help. Don't even buy anything. Don't buy anything from me. Right? You don't have much money. So come to this webinar every single day for a year. Practice on a demo account. And I think you'll have a decent shot. If you can do that. If you got to get rich quick, it ain't going to happen. And don't worry about it. Okay? Right? But like, hang with me for free for a year. Practice on a demo account for a year. And I'll fix your trading problem. Okay? That's got to be the best offer anyone has ever received. Hang out with me for a year. And let's try to develop some skills, technically and fundamentally. At least by then, you'll have money saved. So save money for the next year. Okay? And figure out why your trading sucks. It's less than a year, right? 1 year is nothing. Oh my God. 1 year is nothing. We will fix you. I'm telling you. We will get that under control. Awesome. Good. Good. So, again, open a demo account with somebody. Okay? 50 to 1 or less. Okay? And over the next year, while you're trading your demo account, I want you to save money. So the way you look at it is, how much money do you want in your trading account 1 year from now? And every month, save 1/12 of that. So once you actually have a better understanding of the market, because you're asking for leverage that doesn't even exist in the United States. So you tell me you're relatively new to the Forex world. And it's screaming the way that you're talking, right? So imagine a year from now, you have a better understanding of the industry, you have a better understanding of fundamentals, a better understanding of technicals, more control over your trading, better strategies in general, and you'll be bankrolled. Oh my gosh, you're going to have such a better start to your new career 1 year from now than you blowing up your trading account, which you're about to do, by the way. Okay? Okay. No, but you're not, Richard. Just the language that you use and the knowledge you've displayed screams you're not ready. So I'm glad you've been all right on your demo account, but no, don't be confident because of that. Don't, back yourself off. I traded a demo account for 2 years. You can do it, right? Good. Awesome. Thank you. Thank you for being here. Cool. So here I am talking about a very delicate thing where I believe this is what the data set points to, right? You guys remember? Imagine these candles now are points in your data set, just like I was showing you in the retail sales one I made up, right? So your Y equals MX plus B, okay? Y and x-axis, B is the intercept, M is the slope. So right now, the fundamental, or let's say we won't even do fundamental, the long-term trend is, statistically speaking, not mathematically, statistically speaking, down. Another way of doing that, if you're like, Wayne, I don't know how to calculate standard deviation and slopes and stuff like that, okay? Well, we have algorithms built into our platform. Okay, so what we're looking at here is if the slope, okay, the rise over the run, or in this case, the fall over the run, says that we should probably do this. Okay? If we're going to keep everything the same. Now, of course, that's not what it's predicting. It just says if you're going to keep the slope the same, remember this is one standard deviation above and this is one standard deviation below. So I'm simply selling at one standard deviation above the mean, which means overbought, in a downtrend with a sloping target that says in 2 weeks from now, we should be, 124. So I'm short at 127.50 and I'm going for 124. So if I get it right, I make some money. I will not deviate from this even if we're up here in March. And that looks radical, okay? That looks radical if something like this occurred. A lot of people would say, that's it, it's all over, dollar strength, CAD weakness, oil prices are coming down, the stock market's coming down, the bond market's going up, cats are living with dogs. And I don't foresee that. Even if it happens, because I also know seasonality, I'm going to blame seasonality. But remember, I see myself as walking through a minefield. So when I'm in here, I will tread very carefully And when we get into a point where we start looking at a move like this, okay, I will tiptoe back in. Okay, because I still have my belief based on what the central bank and what the monetary and fiscal policies of the United States of America. This pair will fall. USD CAD will fall. So if I have 2 weeks where it doesn't go my way, I just got to know. There shouldn't be a fundamental change. And I will blame that on seasonality. And I will tell you, over the course of 20 years, if there's going to be a move, which I will call an outlier move like this, if there's going to be one, it's going to be now. That's why I know I'm in a landmine, in a minefield. If there's going to be an outlier, it's going to be now, in the next 2 weeks. So I have a choice, buy, sell, or hold. In this case, I'm going to keep selling, but I'm going to make sure every step is careful. Okay? And right now, I think technically I did everything I possibly can to make that to be true. So like I can go into the 1 hour here. Let me open this up. And there's a lot going on here, right? Let me just reset this. Confluence. Okay? So what do I know? Hang on. I'm going to... No, I'll leave it there. What do I know? Okay. I want to... As a bear, I want my general price zone is there. I want to sell below 128. Okay? Done. You understand that? Like, right off the bat, I want to sell below 128. If it's above 128, I'm going to take a walk. But right now, I knew this last week. Even when we were down at 125, I'm like, I want to sell at 128. I'm pretty sure dozens of people in my swing trading group also had the same plan. Okay? I will also sell higher, but with a much different attitude. But I will wait. Okay, the second part, okay, is this. Okay, there's your central. There's your R. I don't see the M. Okay, but it's in here somewhere. So part B of my technical trade plan is somewhere in here. I want to sell now below 127.50. That's a weekly plan. My monthly plan is 128. Okay? Okay? And also, I also know that somewhere in this period, I want to do it. I know the price, I don't know the time. I have a pretty good idea of the time. So what I did now, and it wasn't good, I had stuff going on. I was a little late, I grant you that. Okay, but delete. Okay, all right. So what I did was I sold this. Okay, done for the week, done for the month. And I've already moved my stop, so now I'm risking, what, 25, 30 pips? Oops, let's go back. And I know I shouldn't be confident. I'm not confident. But I'm doing my job is how I look at it. And it's a difficult thing. How do you choose between the short run and the long run? Okay? And you better have solid rules of engagement. Is all I can tell you. Okay? You better have solid rules of engagement. So let's try it this way. Swing trading bearish. Okay? Solid rules of engagement. So this is what I did. It opened down. I let it up, and then I sold it. And this is where we're going. Okay? And if it goes higher, what do? Back the heck off. Now, I still have 128 I can play with, and then the other one's way up here like 130 or something. So it's just the first shot. It's the first shot in a long game. I'm going to have a lot of work to do in March. You see that? But I'm trying to do what I need to do. Or at least, put it this way. I don't know if I'm right, but I have that issue of, at least I'm thinking about the issue of March. Okay, March up, 2021 down. How do I deal with it? How would you deal with it? The most important thing is you're asking yourself the question. Most people don't even know the question exists. You see that? Most people don't even know the question exists. So think about it this way. If USD CAD goes up and up and up, and I lose a little bit of money on it, I'm still going to trade the fundamental trend. For those that traded it up and made money, most likely they're going to trade it up again in April and lose money. But I'll make money in April, May, June, and it'll be great. And of course, because I know to be careful, I'm not likely to lose a lot of money. I'm not going to put myself in a situation where, I can't recover from a March, because my March isn't going to be losses. March is going to be me trying to get into my trades. There's a difference. I'm beginning the process because I can't pick tops and bottoms. Picking bottoms is a strategy that always stinks. Think about that. Picking bottoms is a strategy that stinks. Okay? But I am trying to, I have the attitude of building a portfolio, and I'm beginning now because I believe in the next 4 to 6 weeks that a top or a bottom will develop. I just don't know what day, what time. I'm not trying to be perfect. If this is it, great. If this goes lower, I'll probably move my stop to break even. If it double tops in the weekly sell zone, I'll probably try again. It's okay. I'm not going to get upset. I'm not going to get sad. I'm not going to get distracted. What were we doing again? Buying, selling, buying? No. I'm building a portfolio. Okay? If I get it wrong, I'll lose a little bit of money. If I get it right, I'll make thousands of pips between now and June. Okay? Cool. So that's what's going through my mind. How do I handle the short run cross current? So we talked about this last week in the swing trading group, how to handle these cross currents. Okay? And many of those traders are probably already in profitable trades like this one. So now I've got a 4-hour 5A cross down. Gorgeous. All right, so let's go back to what we were doing. Sorry for the distraction. Thank you for the questions. All right. Canadian current account. No, I think I'll skip that. ISM. So what you're going to find on these ISMs is they're all well over 50. I think everybody, like Japan came out 58 last night, right? It doesn't show me last week, next week. I have to go backwards. So anyways, Japan came out 58 and China came out 59, and you know, there's a lot of decent numbers, right? So look at, right, Germany's throwing out 60. This is all good. Like, that's all that matters. So your scorecard, whether it's 58 or 59 or 55, what you're looking at is anything over 50 is expansion. So Peter's like, is that good? Well, that's the great question, right? Like, what does it mean? Anything over 50 means it's getting better. So 55, 56, 57, 58, yeah, it's good. What does it tell you? Less need for the central bank to be accommodative. So the central bank is looking at that data too. Okay? But what is the central bank trying to create? Inflation. How are they going to get inflation? Weaken the euro. How do you weaken the euro? Buy bonds, print money. Unfortunately, the euro is going to strengthen. So there probably won't be a change at the central bank that is opposite of what's happening now, and that's what's relevant to the value of the euro. Okay? All right. Anyways, going out here, RBA coming up. Okay? So I already addressed ISM. Everything should be over 50. So if it, think about it this way, guys. It was 58.7. Now it comes out 58.6. But what if it comes out 58.9 or 57.2? Does it really matter? Honestly. Beyond a 12 pip volatility play? Will it matter? If ISM comes out 56, or will it change the policy at the Fed? The Fed already stated what they want to do for the next 3 years. So if we get slightly disappointing or slightly hot numbers, will it change what the Fed's doing? No. Therefore, put it on your scorecard, but it's irrelevant. It had no impact. Okay? Yeah, we hot. That's good. Good. Let it come out 60. Okay? Let it come out. Because it tells the Fed the policy it's using is working, so why would you change it? Well, you're not going to change it. You see, like, it's all self-reinforcing. See, if the numbers came out bad, if we were at 48, not 58, if we're at 48, the Fed would be thinking, well, maybe we should go negative on interest rates, or maybe we should buy more bonds. Maybe we should do something different. Maybe we should do something more. Maybe we need to create some radical monetary policy to spur things above 50. But we're not at 48, we're at 58. And the Fed already said, look, we're going to let it run hot. We're going to overshoot potential GDP. Are we at potential GDP? No. So then it's all irrelevant. Okay? Solano Club says, hey, Wayne, this could be important or helpful. Would you be profitable trading your macro plays even in seasonality? So I think what you're saying is multi-year. What percentage of professional hedge fund managers that are long, short equities hold their trades more than a year? Probably all of them. Nearly all of them, right? And there is seasonality in the stock market. Would you agree with that? There are times to buy the stock market. There's times to sell the stock market. There's times when trading volume is high. There's times when trading volume is low. There's certain news events that could highly impact or contract the stock market. So there's plenty of ups and downs. But the vast majority of the market participants buy and walk away. So could you do that with the foreign exchange market? Well, only if you believe it's right. Like, think about it. Someone that buys the stock market and walks away, they believe the stock market's going up. Are they leveraged 300 to 1? No. Because if somebody farts, their trading account blows up. So if they have no leverage and the stock market drops by 10%, you're like, whoa, that's terrible. But it's not the end of the world per se. If it drops 10% and you're leveraged 10 to 1, you're bankrupt. So they have different attitudes and stuff, right? But my point is there's seasonality, there's business cycles, there's news, there's good times and bad times. But ultimately, if you are a market participant in the stock market, you believe the stock market's going up, so you buy. Ideally, you buy low, but maybe you don't. But at the end of the year, it's higher. So why do you have to trade 5 different ways in one day? You're long, you're short, you're long, you're short, you're long. Like, could you not just simply buy with low leverage or no leverage and come back in a month? Come back in 3 months? Come back in 6 months? On says, can the Fed be wrong? Well, that's irrelevant, though, too. Because they initiate a policy, there's no right or wrong. There's no good or bad. There's no morality in what we do. So if the Fed enacts a policy, it will have an outcome. And then if the outcome is counter to what they're trying to do, they will change, and then we change again. Richard says, well, what about stops? Yeah, you have them. And that defines the risk per trade. Okay? But what I'm talking about, Richard, is you buy... Okay, let me throw down some numbers. Let's say you buy the Euro USD. You think the Euro dollar is going to go up between now and the end of the year. Okay? Why? Who cares why? You think Euro dollar is going to go up by the end of the year. Great. Let's say you trade one mini lot, which means every pip is worth $1. So you buy the Euro dollar with one mini lot, and you put a stop 100 pips away. Your maximum loss is $100, and let's say that's 1/10 of 1% of your trading account based on how much money you have in the account. Or 1%. Okay? Whatever. You have to make a determination. All you're doing is changing your risk. So 1/10 of 1% versus 1% was 10 times more risk. Okay? It wouldn't matter per se how much leverage you have. Is it 500 to 1 or is it 50 to 1? Who cares? You're doing lot size relative to account size. Okay, so the next part of this, Richard, is you enter that trade and you come back a week later because it's a swing trade and you're profitable. You're up 150 pips. Cool. So you move your stop to break even. Now you have zero risk. And you do it again. Okay? You only buy dips in an uptrend. And if it's not an uptrend, you don't buy dips. Each time, you're only ever risking that 1/10 of 1%. So you're never over leveraged. Your maximum risk now is always going to be 1/10 of 1%. But then you might say, but Wayne, I got all these profitable trades open. Well, then that's opportunity cost. So you might be risking 1/10 of 1%. You might have 10 trades open worth 3,000 pips, but you're still only risking 1/10 of 1%. Plus, any opportunity cost because you can take your 3,000 pips and walk away. Well, when do you do that? When do you walk away? Do you do that the third week of June? Do you do that the third week of December? Well, to understand these things, then there's an element of seasonality. Are you buying in March? Are you buying in October? Why would you buy in March and October? Well, because you think in April and November it's going to rally. So now you have to have a little more alpha. So your alpha now is your understanding of the beta. The beta is the market. Seasonality is the market. You can benchmark yourself against seasonality. Okay? But through risk and piss poor trading, you're just going to blow up your trading account. Okay? So just remember, what I'm teaching you are things like the concepts of business and economics. Economics, by the way, is simply a social science focused on logic. It's all logic. Okay? So if someone is teaching you something using gobbledygoo magic, and they're showing you this stuff, and they're like, well, this tells you that, and therefore it has to do this, run away from it. It's stupid. If it's not common sense, if you don't understand the why, the market's going to go up because of something. Because it's a business transacting with a business in another country. If you can't find what that's about, because remember, that's all foreign exchange is. A business in the United States is going to transact with a company, right? Another business in Australia. Which way is the money flowing? Oh, it's going to flow from the United States to Australia for investment purposes. Oh, the dollar's going to get weak, the Aussie dollar is going to get strong. Why? Money is leaving the United States and going towards Australia. Common sense. Why is it happening? There's a business transaction. Well, is that one business transaction large enough to move the foreign exchange market, which is 5 or 6 or 7 trillion a day? No, of course not. So we have to look at the aggregate. So if there's going to be lots of deals like that, well, then we have to say, well, there has to be lots of macroeconomic activity globally. Is the United States doing business with a lot of different countries? Is Australia collecting business investment and customer transactions from their customer base globally? You have to say, well, wait, why would that happen? Oh, Australia is a commodities producer and exporter. So, right? So in times when there's lots of macroeconomic activity, aka stuff is happening, then China's going to need to do a bunch of stuff. And if that's happening, they're going to need natural resources, raw material, and they're going to buy a bunch of it from Australia. And we will see that for demand in Australian dollars, which is another way of observing macroeconomic activity growth. And we care about that. That's what we care about. Okay? Sometimes you have to look at it indirectly, but sometimes you can see it directly. Like you can only see a black hole indirectly. So in that case, you could say Australian exports represent global macroeconomic activity, which means there's going to be lots of business transactions. Many of them are going to be done in dollar because it's a reserve currency. Okay? Also, yen is a savings currency. Very often I call it a funding currency. But what's the opposite of a funding currency? A savings currency. So when things are bad, people save in Japanese yen. When things are good, there's no reason to save. What's investment? Do you guys know what investment is? Well, what's savings? Consumption minus what you don't spend. Okay? So you make $100. You spend you buy $80 worth of stuff, and you don't spend $20 worth of stuff. So apparently you save 20%, Okay? Consumption minus whatever you don't consume. Okay? So now you got savings. Okay? But now, what happens if you save it? It turns into investment. That's what banks do. One major reason poor countries stay pathetically poor, desperately poor, is that they don't have a banking system. So they don't spend the money. They're like, I'm going to save money so I can buy more potatoes next month. But it doesn't turn into investment because they don't put it in a bank. They put it in a coffee can and bury it in their backyard. They put it under their mattress. And there's no investment. There's no economic growth. There's just a lack of consumption, which means that $20 doesn't get turned into someone else's income, and there's no expansion. Okay? So, put it this way. If you save it, it becomes investing. Okay? So imagine you save it, and you save it by putting it into Japanese yen. So that means you buy Japanese yen, and the yen goes up. But when you see deals, opportunities to put your money to work, when you see opportunities to hustle, turn your $20 into $25, you put it to work. So you invest it yourself. And the yen, you take your money out of Japanese yen and you send it to Australia because they'll pay you a higher interest rate, or you got a deal going on there, but you put it to work and the yen weakens. So now it's a funding currency because you're funding your investment in Japanese yen. You're like, hey man, I'm going to put money into a gold mine or an iron ore mine or whatever in Australia, and a diamond mine in Australia. Okay? So you fund your projects with that. But when the projects are risky or not producing, you save it. And right? So you start to understand these concepts of flow. And that's what you base your Forex trading strategies based on. Logic. So if some guy is saying, well, this is 26 degrees and this is 18 degrees, therefore, the euro dollar is going to be here. Run away. It's stupid. It's stupid. Run away. It's dumb. Okay? They're just trying to excite you to get you to buy their crap. But don't believe it. There's no common sense to it, therefore it's stupid. Okay? Yes, William, yes. Spending is someone else's income. Yes. Oh, you mean income minus expense? Yeah, it's the same thing. You're saying the same thing. So the amount of money you make minus how much you spend is savings, but then your savings is what you haven't spent is all what I'm saying. But you could also savings, you take the savings rate times your productivity, or let's say over GDP or something. Okay, so you could do it like that. Okay, but whatever. All right, so let's move on. So Canadian GDP, very nice, very nice. We want to, right? Very nice. We want to see good numbers, obviously. Permits, kind of a neat leading indicator. Aussie, right? A lot of Aussie this month, right? So you got your RBA statement here. Pay attention to that. And then again, right? Lots of stuff going on there. Your German unemployment. All right. Just seeing anything crazy here. Beige book, you should read it. ADP, decent scalp. Aussie retail sales later on Wednesday night, Thursday morning. That's often a good one. There's been some soft data out of Australia, so I'd like to see some better numbers. Okay. So we'll see their GDP and then retail sales. The difference is here, GDP is going to look backwards. And retail sales is going to tell you now. And I'm not really interested in what happened in the fourth quarter. I'm more interested in, are things improving right now? Because generally speaking, the numbers out of Australia have been soft. Like housing numbers have been soft. So I'm like, I'd rather see some good retail sales here. Okay. I'd like to say, well, maybe consumers have shifted away from investment, but are picking up consumption. Because remember, you still need your, Y equals C plus I plus G, for example. So if consumer investment is down, then I want to see consumer consumption up. Okay? Because remember, a subcomponent of I isn't just business investing, but retail housing. Okay? Because buying a house for 30 years is considered an investment, right? So if the number has been soft here, I'd like this number, consumption, to say, well, they didn't buy a house, but they bought a TV. They bought a car. Okay? So I want to see it somewhere else. Okay, I'm skipping along because NFP obviously is going to be the big one on Friday, non-farm payrolls. And then check out all this data on Saturday. Chinese import, export data, trade balance. Okay? CNY, baby. The first step, Richard, is you have to complete all the training courses at FX Bootcamp. So fxbootcamp.com. Remember, I don't teach in the swing trading group. If you haven't completed the courses, you don't know how to swing trade, then you need to do the course. Okay? Right? It's a group, not me training. Okay? So anyway, pretty okay going on. It's all right. It's a pretty normal week for this time of, just a pretty normal week. Okay, one of the things to show you here is, let me put this on highlighter. The first thing you want to highlight is this one, buyers. So buyers are here. La 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 la. Okay? So the la 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 part is right here. So since the end of January, there's been some buyers of the euro. Okay? Nice. Cool. Okay? And now what we want to look at, let's do this in a slightly different color, a darker yellow. The next thing we want to look at is sellers. Okay, so now we got to look at this. Okay, notice since here, there's been very few sellers of the euro. Okay. Cool. Because if you go back to the beginning of this period, back in this area, okay, I became a buyer of the euro. So this goes back to someone else's question. Can you trade much longer? Can you trade something for years? Well, in here I became a buyer of the euro. And since then, the euro, there's been more buyers than sellers of the euro. Significantly more in some cases. Okay? So what we're comparing right now, let me do this in a slightly different color. Okay? We're comparing the amount of sellers to the amount of buyers. Okay? And since the end of January, statistically, I would say there's been no change. Okay? Statistically speaking, you probably shouldn't be trading the euro dollar. Nothing has actually happened. which is to say, if there's been a 5% increase in the number of sellers, there's been a 5% increase in the amount of buyers, and they offset each other. And this is the net, by the way. Okay? Week over week over week over week. And there's been statistically no change. Cool, right? The reason is the euro gets weak when the dollar gets weak, or that's what's been happening. So you should probably not trade this. Can you see that? Peter says, so with China, I don't know what else you would trade Aussie dollar for. Does the United States get a significant amount of iron ore and coal from Australia? Wait, we have our own iron ore and coal. Why the heck would we ship it in from the other side of the planet? Okay. So how much of it gets shipped to China? Statistically, probably significantly more. So the only reason, right? Just how about this, Peter? The better question is, who are the major trading partners with Australia? Why don't you go to the central bank, the RBA, find out the major trading partners with Australia, the number 1, number 2, number 3, and see if you can somehow trade that knowledge. Okay? Cool, right? Mohammed says, in Japan, you think, yeah, maybe, but the United States buys a lot of cars from Japan. Okay? So anyways, so there we go. That's what we're looking at. So just for fun, I'll skip to a completely different currency. Did that update? Hang on. Let me put it back. Euro 28. Yeah, and now we go Aussie. Yeah, okay. All right, cool. Nice. And you can see, right, we can skip ahead now, and we can just look at this, which is the net. Buyers minus sellers equal net. Okay? So it was down, then it was up, then it was down, then it was up, and if you average it out over the last 4 weeks, nothing's changed. Okay? Since the beginning of the year, it's been up and down. So one of the things you could look at is this line. I know it's hard to see. Let me make this marker. Okay, highlighter. The 0 line. Wait, that was supposed to be highlighter. Was that highlighter? Oh, I guess that doesn't do highlighting. All right. So anyways, that's the water line. That's our neutral line. Okay. So one way you might want to look at this is heavily selling. And above here would be buying. And not a lot of action otherwise, right? Right? There were significantly more bears on the Aussie dollar. And then we got to fairly neutral. Fairly neutral. Not a lot of activity. Yeah, yes, right, Daniel, but we want to know who is buying it. Oh, I see. Of this exported to China. Yeah, okay. Thank you. Okay. So, let me ask you then, if this is the price of the Aussie dollar, what happened? Would you agree that from this period to that period, not a lot has changed in the amount of dollar buying, Aussie dollar buying? So what happened? Why is the price of Aussie versus USD at 79? If really there hasn't been that many buyers or sellers, or new buyers or new sellers, or more buyers or more sellers, how could this go up if there's really no change in the market for Aussie dollar? Daniel, make people do their own work though. Huh? US dollar weakness, thank you. So I'll go back to what I was saying before. Back here, okay, I said this thing would go up. Aussie dollar would go up. Not necessarily because of the Aussie, maybe, but primarily, if not exclusively, because I'm a seller of the US dollar. So, one way of looking at it, right? Let's look at this. Long net commercial contracts. So let's do this, what is this? This year. Okay. This year. And then we'll go to last year a little bit, and then we kind of head back up. So, let me do it this way. Going back more than 12 months, about 12 months. Okay, going back about a year. But even all the way this year, which occurred right in here, okay, on average, there's no new buyers. You can see there were less buyers at the sort of in September and October. Then it popped up at the end of the year, and since December, we've had the same amount of buyers. There's no new buying of Aussie dollar. Okay, it's this number of contracts, something about 60,000 contracts, long Australian dollar. Okay? And no real change in the amounts of selling Aussie dollar. So how could we go from 60 to 80 if no one was buying the Aussie dollar? The US dollar was falling. And that's what I've been telling you day after day after day after day after day. Nobody is buying the Australian dollar. But the Australian dollar versus the US dollar is going up. People, the market, the world is selling US dollar. Why? Increasing macroeconomic activity. Okay, so I want you to think about this, going back to the scorecard. What does the scorecard do? It's measuring rates of inflation, levels of employment, levels of this, and levels of that. Do you understand that this is a global question? What is your scorecard going to tell you? The interesting part here is because of global macroeconomic forces. Nobody gives a damn about quarterly over quarter PMI. Oh my God, it was 58.7, but we were thinking 58.6. Oh my God. No, look, think about it in much simpler terms. Is the world going to increase the amount of business activity from the recent past? Well, what happened in the recent past? Everything was shut down because of COVID. So are things going to slowly reopen? Yes. Will that increase economic activity? Yes. Then the Aussie dollar is going up. Why? Because of the Aussie dollar? No. Why? Because of your USD scorecard? No. Because of a global outlook for business activity generally. Think about it. When China comes back online and India comes back online and Brazil comes back online, these, right? Just the economic activity and who's going to supply these economies with stuff, well, right? And where are the natural resources going to come from? Where are the deals happening? Where's the investment going? It's only money, guys. Right, because of dollar down. Why dollar down? The dollar is going outward. It's being used as a reserve currency. Things are being priced. Deals are getting done in terms of dollar. Okay? More activity, more weakness. Okay? And therefore, in terms of dollar, the dollar's weakened significantly versus the Aussie. Aussie hasn't done much of anything except go up relative to the US dollar. Now, relative to gold, probably not. Relative to Bitcoin, probably not. Relative to what? Well, we're trading this in dollar, and I told you April 9th, the dollar was going to fall for at least 5 years. What more do we need? Check your scorecard, son. Right? What more do you need? The Fed clearly told us. Now, look, if you don't have a master's degree in economics, then you're like, I didn't understand what Jay Powell said. Luckily, I was here. I explained it. And now you understand not whether I'm right or wrong, the basis of my strategy. And so now when I explain to you, I expect the dollar to get strong, but I'm not going to buy it. You have to say, well, dumbass, what? If you expect it to get strong, why wouldn't you buy it? Because that's just short run. And it's going to get a lot of people chasing their tails, running the wrong way. Okay, they'll lose some money in the beginning of the month, and then they'll lose it all again at the end of the month, and then they'll do the wrong thing in April, where I'm just taking the opportunity to clear my slate and then start building a portfolio that maybe I can hang on, hey, maybe all the way to the end of the year. I don't know. I'm not in control of those market conditions. Okay? But isn't that neat? Aussie dollar has gone up and nobody bought it. Only in terms of dollar. But that's what we do, guys. In terms of what? What is a Bitcoin worth? Well, the next thing is, well, in what? How many dollars? Oh, okay. Well, there's an answer for that. It's worth less in euro. Why? Euro is worth more than $1. Okay? In terms of what? So at the very least, get half the equation correct. That's what I'm teaching you. At the very least, understand that the dollar's weak. Okay? And then you can go figure out what is actually strong. Well, how do you do that? Well, that's for you to decide. Okay? Cool. Okay? So like I look at this, I want this to fall, right? Statistically speaking, let's put it this way. I want this to fall, but statistically speaking, remember what I was teaching you like 25 minutes ago? Y equals mx plus b. Sorry about that one. Okay? Y equals mx plus b. And if I'm a seller, I want M to be less than 0. Right now, you can clearly see M is greater than 0, so I'm going to wait. Which is another fancy way of saying, wouldn't it be great if we got a head and shoulders pattern? Yeah, it would. So I might as well wait for that. Sure what I'm talking about? All right, so it looks like I've gone almost 2 hours today. I apologize. I tried to keep them tighter, but you asked some good questions. So I hope your week and your month has started out really good. Thank you for being a subscriber. Thank you for being a client to Trader's Way. If you want to take my training courses, the link is in the description below. 80% off right now, or 76.4%. What else? A link to Trader's Way if you want a demo account. That's in the description below. My tools, like all these pivots that you see here, the link is in the description below. The link to my book is in the description below. Whatever. There's plenty of resources that I've made over the last 20 years of coaching because people have asked me for them. So if you want help, yeah, it's there. Cool. So just to sum it up, I don't know what's going on this month, so I'm creating plans and strategies to tackle the uncertainty, and I'm doing my best to accept risk, but manage risk. It's a minefield. Be careful where you step. Okay? Not a good time for a marching band. So, peace on earth. May the pips be with you. May your profits be above average. I'll see you tomorrow here at Forex.Today. I'll see you Wednesday at Forex.Today. I'll see you Thursday at Forex.Today. And then on Friday, I'll be at FX Street for non-farm payrolls. Okay? For those that are in my macroeconomics course, no lecture tomorrow. But the topic I'm going to cover is going to be covered over the course of 2 lectures. So it's very complicated, and we're piecing it all together and stuff like that. So no lecture this week. So there's a skip week, and then so next week and then the week after. Lots of good material coming your way. I'm excited, actually. I like geeking out on this stuff. So I'll see you guys tomorrow.